It is time now to introduce our first guest, also somebody who has been around for some time and will remember very, very vividly 9/11, and that's Jim Bianco, founder and president of Bianco Research, based in Chicago. And I'm sure, Jim, it would have been a fearsome sight to be watching that on the floor, on the trading floor in Chicago.
Yeah, I remember 9/11 in a lot of ways like it was yesterday, and it was. I've been in the markets for 33 years, and it still remains one of the seminal days of my career.
Jim, it's been a difficult time recently, and today obviously it's extra difficult for a lot of people, but the difficulty that we've seen in the last few months, does it persist through the end of the year and into the next year in terms of economic fundamentals, in terms of just general suffering out there? We'll get to the markets in a moment.
Yeah, you're right to point out that there's the economy and what's happening with the economy. And I do think that what we've seen is a series of stumbles. The economic recovery off the COVID low in May seemed to have stalled around July. The need for stimulus, because remember the government shut down the economy and a lot of people lost their jobs because of that, seems to be dead now since to at least past the election. And that's going to also kind of drag on the economy as well, too. So I don't think the economy is going backwards. I just think that the recovery to something that was a pre-COVID normal has stalled, and we've got more evidence that it's going to be even harder to get back there. So the economy itself seems to have just flattened out at a lower level, and net, that's not the best place to be.
So, Jim, given that backdrop and given the fact that Congress looks like it will be unable to deliver at least a near-term fiscal stimulus, what are investors to do? Are they just simply leaning back on that backstop, which is the Federal Reserve and ECB, just providing tremendous liquidity in the market? And is that all we need?
Well, that's what we have. Let's put it that way, because what we talked about with the economy, let's add in then that if you look at valuations and you look at the forward PE ratios, even if you take out the FANG stocks, you're near the 2000 bubble peaks in terms of how overvalued this market is by a lot of metrics. Others aren't, but a lot are. So this is, by no stretch, is this a cheap market. So if you're an investor, you're saying, look, the economy's stalling, the market's overvalued. Boy, that sounds like a really bad mix. Why am I in this market? Well, you've got the Federal Reserve, and you've got the government that's been promising to bail out the airline industry and the cruise ship industry, and they're not going to go down without a fight to at least protect investors. We could debate whether or not that's ethical or proper for them to do it, but that's what they are doing, and that's a big support for the market. And I don't know if it's enough to push the market up, but it's enough to really temper being very bearish at this point. So that's why I think we're going to have a 10 to 15% correction. We've already got 8 of it done, so we're already halfway there, and probably continue to grind sideways for the next several months.
Jim, being a fixed income and volatility expert, what do you do in a market like this? Do you trade it? Do you stay on the sidelines?
Yeah, the bond market has been a real tough one for traders because there's nothing to trade. It doesn't do anything. We're now down to watching 3 basis point moves, which are not very significant in pre-COVID world as something meaningful, but they're really not. I think the way you want to look at the bond market is the big basic question is, does all of the stimulus and all of the Federal Reserve action and everything worldwide, let's put all the central banks in there, lead to inflation sometime next year or 2022? I think the answer is yes. And I think that's going to put upward pressure on interest rates, at least in a year or so, not immediately. And that would be my bias towards trading the market. But your basic question is right. It's a tough market to trade because it doesn't do much of anything right now. It's been one of the narrowest ranges we've seen in the history of the bond market over the last 3 or 4 months.
All right. So, Jim, sticking with the bond market, where in terms are we seeing credit quality issues creeping into this market in a meaningful way? We had early on in the pandemic, some of the retailers, file and kind of talk and, disclose the financial hardship they are having. Are we seeing more of that in other sectors?
Yeah, credit quality, you can look at it one of 2 ways. You can look at just the fundamentals of the companies that are issuing debt and saying, how creditworthy are they? And the answer there is, yeah, you can see some definite signs of credit quality issues. The other way you could look at it is, well, how about investors? Are they demanding more, tougher standards in order to borrow or let companies borrow? And the answer is no. They've just been head over heels and grabbing anything that they can get their hands on because we've been setting debt issuance records. We've already broke the yearly record, and it's only September right now. So, yeah, shakier companies are allowed to trade debt, and investors are stepping up on it. Why are investors buying the shakier debt? I hate to come back to the same issue again. The Federal Reserve is buying the stuff too, and that there's a perception that there's a backdrop in there. And the battle cry on Wall Street has been co-invest with the Fed. If they're going to buy corporate bonds and corporate ETF tied to corporate bonds, you should too. Don't get hung up on the credit quality issues. And that seems to be what has driven this absolute need by corporate investors to buy corporate bonds, even no matter what the credit quality is.
Is it wise for companies to continue to issue, Jim? I mean, I suppose the obvious answer is yes, right? Issue as much as you can until this era is over. But at the same time, will companies have a headache after all of this?
Well, it depends on why the company's issuing. If you take a company like Six Flags or Carnival Cruise, they issued a tremendous amount of debt early on in April and May, so that they had enough cash that if they never open Six Flags, if they never open their theme parks, they're still going to be in business next year. And so that made sense, that they were looking over the ravine and trying to get to the other side. But if you're a company like Apple or one of the FANGs, you don't need the money. Should I just go out and borrow it just because I can? That could be a situation where down the road you could say, why did I do this? It just puts an extra burden on me. I didn't need the money, but now I got to pay it back as well. So it's not always a good thing to borrow unless there's a specific reason. Carnival and Six Flags had a specific reason. Some of these other companies don't.
So, Jim, if investors are searching for yield and maybe they're willing to go down the credit chain a little bit, potentially having that Federal Reserve backstop, how about emerging markets? Is that too far out, or are there some areas there that you're seeing some opportunities?
That might be a little too far out because there is no backstop there, for one. Two, they are really a levered play on the emerging markets are in a levered play on the global recovery. If you think the global economy is going to recover from the pandemic, they should do better because they will benefit from it, even if you take China out of the equation because they're such a big player in it. But really, you've got to look at that a little bit differently. You've got to look at that more fundamentally and answer that basic question. Are you expecting a global recovery? Well, we flattened out in the U.S., and the case counts in Europe are back to their April peaks. Sounds like a recovery continuing, again, not necessarily going backwards, but continuing, is going to be difficult, at least for the next several weeks or few months. And I think that emerging markets are going to, stall in that mix until we see some clarity on whether or not we're back on the road to getting to something to what we would call pre-COVID normal.
Jim, are you spending more time looking at Europe these days? There's definitely a little more action in Europe.
Yeah, exactly. I have been spending more time, with the strength in the euro and with the higher case counts of COVID and the lack of their markets not being as overvalued as the U.S. markets are. They're not back to their highs. Europe has presented itself as some interesting opportunities with a lot of cross currents. It's a mix to try and figure it out.
Yep. Hey, Jim, thanks so much. Jim Bianco, founder and president of Bianco Research.